Well, hello everyone, and thank you for taking time out of your busy day today to be with us. My name is Alan Frisbee, and I'm the life insurance sales manager here at Financial Brokerage. Today is the final session of our three-part series on business life insurance. On the first two sessions, we discussed foundations of business life insurance planning. We also discussed buy-sell planning and key person life insurance. Both of those sessions are recorded and available on our website for you to watch again. This one will also be recorded and available probably in a day or so. Today's session is on executive bonuses. We are lucky to have Michael Deaton. He is a business insurance consultant from Lincoln Financial Group as our presenter, and I will let him take it away.
Thank you, Alan, and excited to be here with you this afternoon. As Alan mentioned, my name is Michael Deaton. I'm a business insurance consultant here with Lincoln Financial, and excited really about today's presentation, kind of twofold. One, this is really where our team probably spends 85%.
At Financial Brokerage, we also have annuities, long-term care, disability, and Medicare supplement. Those commissions also go towards the qualification, so let's try to get you some vacation time. I would now like to introduce two business insurance consultants from Lincoln Financial Group that will present to us today, Michael Deaton and Jordan Walker.
About ways to reward, retain, and recruit top talent. But before we kind of dig into the insurance solutions that help drive executive benefit planning, I did want to recap what we've talked about in the first two sessions, and that's really drilling down into the risk associated with business owners and helping them fill those gaps and really disturbing them around areas in their business that they should be concerned about. And it really starts with, one, helping business owners identify the loss or disruption to the business if they were to lose a key employee to death. You know, how does that impact a business's continuity, its revenue, its client relationships, and ultimately unlocking the insurance solution there, you know, with a key person opportunity. Secondly, helping business owners understand the importance in the critical aspects of buy, sell, or succession planning. And really what we're talking about there is making sure that we've got a strong, formalized process, agreement, and funding solution that is going to efficiently transfer business interest among business owners. And again, that's helping protect not only the business, but those business owners, beneficiaries, and estates from not realizing the full market value of their equitable interest in that business. And then in today's conversation, helping businesses really understand the impact of losing top talent to competition. And that's really focusing those conversations on strategies that are going to help retain, reward, and recruit top talent. And it's not too different than the conversation around key person, and we'll talk in just a second of how that those conversations really bridge between one another. But really, the retaining, rewarding, recruiting top talent is something that business owners are constantly struggling with, is, you know, retaining those top talented individuals for driving business successes, driving revenue growth, or devising product development. So real quickly, how do we unlock the life insurance opportunities across those three pillars of risk management in the business insurance planning process? Well, first and foremost, we've got to start with that business owner, helping them secure their retirement first. And that really is starting with that buy-sell or succession planning first and foremost. With that business oftentimes representing the largest source of revenue and oftentimes the largest asset of that business owner's portfolio, it makes sense to start conversations first around securing their retirement and making sure that we've got a proper plan in place to help address their retirement needs and the succession of the business interest. Once we've helped the business owner really kind of complete their retirement plan and close those income gaps, really the question, and we kind of phrase this in a very casual conversation, is, hey, Mr. and Mrs. Business Owner, if you had to close up shop tomorrow and move across the street, who would be the one key employee that you'd take with us or take with you? you could expand that, or who are the 2 or 3 top individuals that you would take with you if you had to close up shop and move across the street. And really what we're identifying here are those key individuals that are instrumental in driving that business owner's success. They very well could be a part of the business continuity and succession planning aspect, that agreement. But really we want to help that business owner identify and quantify the value of those key people to the organization, and making sure that we've got adequate coverage in place to manage it if we lose them in the event of a death or disability. But at the same time that we're helping that business owner identify the impacts of losing those key people to a death or disability, we also want to be thinking preemptively about what if we lose them to competition. So twofold, those conversations really kind of can be bridged between one another. If you're talking about executive benefits, then you've got a key person opportunity. If you're talking about key person coverage, you're probably in the same seat to have an executive benefits conversation. So I wanted to tie the 3 segments together: the buy-sell planning, the key person coverage, and the executive benefits into a process. And again, focusing on what we feel is the best approach to be the most successful in that planning process. So the executive benefit spectrum. So what is it? Really what this is driving home is the need for the business owner to recognize the important factors that are going to keep top talent. How do we retain them? What incentives are we going to do to reward them? And for going out and helping businesses recruit top talent, what types of compensation programs can we devise that will differentiate ourselves as a small business owner from, albeit our larger employer counterparts? So really, this is the part of the conversation really where we're emphasizing the need for planning, the risk of not helping that business owner devise the appropriate compensation plans to, again, retain, reward, and recruit top talent. So when we're looking at various insurance strategies to complement that need for retaining, rewarding, and recruiting top talent, we find that the options really kind of fall on a spectrum. And from the visual here on the screen, really what we're emphasizing here is that in your discovery with your business owner client, one of the important aspects in that discovery process is who is the business? What type of business entity structure are we? Is it a pass-through, or is it a for-profit business that's structured as a C Corp, or is it a not-for-profit entity? And then are we looking to reward the business owner himself, or are we looking to reward a key employee? As we filter down through those decisions, it puts us on a spectrum of opportunities, the solutions that we can bring to the table from implementation. So in this spectrum, on the right-hand side, we are going to have strategies that favor more employee control and have less of a handcuff, less of a retention mechanism built into the strategy. Whereas on the left-hand side of the spectrum, we're putting more control and emphasis on, benefiting and giving that handcuff lever, if you will, to the employer. And somewhere in the middle is split dollar programs. Loan regime split dollar, oftentimes one of the more attractive ways to really kind of balance that need to maintain employer control, all the while rewarding our key executive. But as we moved left to right, or right to left on the spectrum, one of the things that plays out in this conversation is that tax deductibility. So another key aspect in the discovery process with executive benefit planning is that tax deduction important to the business? And I think tax reform certainly for certain tax structures have made it more advantageous, either one, to accelerate deductions through programs like a Section 162 executive bonus plan, or in some cases with a C Corp entity structure, utilizing business tax dollars and funneling dollars into strategies that are more corporately controlled, like loan regime, split dollar, or deferred compensation. So again, two critical aspects to the discovery process with the executive benefits conversation is who we're looking to reward, the key employee or the business owner, and is the tax deduction important? And then that allows us to better funnel and put out a spectrum of solutions that are going to fit those business owners' needs. So let's start with the Section 162 Executive Bonus Program. This is the one that is going to favor, in terms of control, the employee the most. So what are we devising here? We're devising a program that really allows the employer to choose what employees get to participate. So this is a distinct advantage using non-qualified insurance strategies where we can be selective over who participates. So we're not having to, unlike our 401k programs, include everyone. We can really determine at the employer level who's going to participate. We're not subject to any major IRS regulations or deferred comp regulations like Section 409A. But the benefit to a Section 162 from an employer perspective is that it does allow them to deduct the premiums, as long as they're deemed to be reasonable compensation. But it provides a very cost-effective and flexible solution for the employer and the employee to put together a supplemental retirement or a death benefit fringe benefit for those key employees that were identified. And a lot of times in these plan designs, we're seeing cash value life insurance being used in really a supplemental income design, as that's really what employers are looking to do to help reward those key employees, is to provide them a meaningful supplemental retirement income. And that brings me kind of to another aspect when we're working with our business owners that should be played out with them, or at least in conversation, is employee identification. These programs really are not meant to benefit everybody, the rank and file. These are really targeted towards that executive carve-out group, those managerial folks. Again, those folks that are instrumental to driving business revenues, maintaining business continuity, key decision makers in the day-to-day operations. Those are the folks that we really want to see as part of these non-qualified executive benefit plans. But Section 162 bonus plan, again, very easy to administer and implement. And so certainly one of those things that, as we're looking to, help business owners readily identify an incentive method that is easy to understand and communicate to their employees, a Section 162 bonus plan is a viable solution. So how does it work? So during the employment, we have a life insurance contract where the employee owns the life insurance contract and gets to name their personal beneficiary. The employer makes the premiums to the life insurance company and treats those for accounting purposes as compensation bonuses. As such, we get to deduct the amount of the premium. This will be the only time that we are able to deduct the premium paid into a life insurance contract. And that's because in this situation, the key employee is the policy owner in getting to name their own personal beneficiary. So as we're treating that premium as a compensation bonus to get the monies into the life insurance contract, the key employee obviously is going to have a financial obligation to that, which is the tax on that compensation bonus, which they pay to the IRS. And again, as we look at this over time, they do this year in and year out. This really allows for an effective way to the employer to receive a meaningful deduction for their compensation paid throughout these key employees, as well as helping that key employee help fulfill and close their retirement income gaps. So, and again, with those highly compensated employees that may be maxing out on 401k plans, these non-qualified strategies that really provide, tax-favored distributions because we're using life insurance as that funding vehicle really makes it an attractive funding solution. But as we've talked about it, this really, because this is an employee-owned contract, we're making compensation bonuses, the employer really doesn't have any recourse. So if this key employee was to leave and go to the competition down the street, the employer really has no method to recoup, their premiums paid into the contract. They really don't have a way to handcuff the employee. So the executive 162 bonus plan really is a great reward strategy, but not necessarily the most effective handcuff strategy. So that brings us to split dollar. And a lot of folks, have heard about split dollar. It's been around for decades. It's certainly been a viable solution to address executive benefit and compensation planning concerns, but it's something that's maybe taken kind of a back seat. But I think what we're seeing with tax reform is split dollar being put back at the forefront of executive benefit planning because, one, it allows for the business to implement a handcuff, and we'll talk a little bit about how that works in a minute. But two, we're also able to use those business dollars, and through the uniqueness and the accounting structures of split dollar, able to maintain those collateral assignments or cash values on their company's books. So we're able to keep those dollars in-house within the business so that it can be more attractive. And there are certainly circumstances and business structures that really play well to that, and we can certainly dig into those on a case-by-case basis. But what is loan regime split dollar? Loan regime split dollar, in essence, what we're doing is we're sharing portions of a policy contract. So a life insurance policy is purchased on our key executive. And there's really two approaches to the loan regime split dollar method. Lincoln has a very unique plan documentation service that allows for that contract to be jointly owned by the employer and the key executive. Traditional loan regime split dollar is owned outright by the employee with a full collateral assignment by the employer. The premium payments are what is classified as our split dollar loan. So as premium payments are made into the contract, those are creating our split dollar loan balance. Because we're involving a loan in this transaction as opposed to compensation, our key executive does have to pay our employer loan interest, but oftentimes mechanically we see the employer helping the key employee with that loan interest obligation by structuring that loan interest as a compensation bonus. The beauty of loan regime split dollar is because they maintain ownership interest via collateral assignment or joint ownership in the contract, really what we're doing is we're helping the employer maintain an asset on their balance sheet. So that can be very attractive for certain types of businesses. Construction companies come to mind, where their balance sheet is very critical to helping maintain favorable bonding requirements. Car dealerships, any type of a company that may be heavy on inventory where they're having to borrow funds to maintain, inventory, that can be very attractive to a business owner when we're looking at executive benefit structures, is what's the impact to the balance sheet? How are you managing that balance sheet as a consideration? And then split dollar also allows for recovery. That's one of the unique handcuff features of loan regime split dollar, is that if our key employee decides that the grass is greener down the street at the competition, through that collateral assignment, through that joint ownership, that split dollar agreement, we now have given the employer a method of recourse at least equal to their premium payment. So that's where loan regime split dollar really can be the best of both worlds, is that we're creating a handcuff. We're not creating deduction for the employer because we're treating these as split dollar loans, but we're also able to reward our key employee with a meaningful benefit. So to break it down into even more simplistic terms, we've kind of created this fancy acronym, PIE, loan regime split dollar, as easy as pie. And really this is just breaking down the key components of loan regime split dollar. So P is equating to premium. So we're treating those premiums paid into that life insurance contract as a split dollar loan, not as compensation to the key employee. And when we create that split dollar loan agreement and those split dollar loan premium payments, the business owner, the employer, takes a collateral assignment equal to that split dollar loan. That's how they're protecting their interest. That's the handcuff for the employer, is that it's the retention mechanism for them, that they get their monies back, or they have a collateralized interest in the policy to protect their interest. not to confuse that with the I in interest, which really what we're talking about here is the loan interest. So we've made a premium loan to our key employee that's paid into the policy, but now we've got a split dollar loan balance outstanding. Our key employee has to pay loan interest to the business, and that's determined by an IRS rate. It's an applicable federal rate, and that is something that can vary each and every year or each and every premium payment. But usually how this is handled from an employer to an employee perspective is the employer will oftentimes bonus your key employee an amount equal to that loan interest obligation to help minimize that out-of-pocket outlay. So as an example, if my premium loan to my key executive is $1,000 in year one and I have a 1% interest rate, I've got, $100 loan interest obligation. I'm going to bonus my key employee $100. They're going to pay tax on the $100, not on the $1,000 premium loan. So it's a more attractive way to minimize that out-of-pocket outlay. And then lastly, the exit. So how do we end this split dollar arrangement with our key employee? There's really two formalized ways. There's cost recovery, and then really what that's referring to is the business recouping from either policy death benefits or from policy values the amount equal to their split dollar loan balance, which if you think about it is really their cumulative premiums paid. And when we do cost recovery, that doesn't trigger any compensation events, where the employer is extinguishing that loan through death benefit proceeds if we have an employee that passes away prematurely, or through a policy withdrawal during the working years. And then the employee gets to walk away with any excess death benefit and cash values. So that's the beauty of this arrangement. The other way is loan forgiveness. And what loan forgiveness is saying, Mr. Executive, you don't have to pay us back. Instead, we're going to forgive that loan, and we're going to account for that loan forgiveness via a compensation bonus to you to extinguish the split dollar loan balance. You're just going to pay taxes on that loan forgiveness event, which is that compensation bonus. So there can be a hybrid way to exit. You could do partial recovery and partial loan forgiveness, or you could even begin forgiving the loan ahead of retirement. What we're really getting at here is there's a lot of flexibility with loan regime split dollar that you have. You've got a handcuff, you've got flexibility from a plan design perspective. You're not subject to 409A restrictions and regulations and reporting that we'll talk about in just a minute. And you can still maintain a program that can evolve as your relationship with your key executives evolves. And that's one of the things that we're seeing loan regime split dollar being well positioned in the new tax reform, is to use those business dollars to create executive benefits that gives a lot of flexibility without tying it to a formalized promise and without just giving all the control to the employee. Which brings us to our last executive benefit strategy that we see oftentimes being talked about as a way to incentivize and reward top talent, and that's deferred compensation. And in this strategy, really what we're talking about is employer-funded deferred compensation, sometimes referred to as a SERP, which, as you can see, is a supplemental executive retirement plan. So one of the things that when we talk about deferred compensation as part of an executive benefit solution, is that we have to unmarry the agreement from the life insurance. What a supplemental executive retirement plan is, at its core, is a promise to pay. It is an arrangement, a contractual arrangement between an employer and selected key executives, again, targeting that your top tier, highly paid executives, a promise to pay a benefit to the employee at some point in time. Oftentimes it's tied to an employee's retirement. It could also include a survivor benefit that may be paid if an employee meets certain vesting requirements. or if a full retirement benefit has not been paid out as owed to them. So you really have to separate out the funding from what is deferred compensation. It's a contractual arrangement between the employer and key executives as a promise to pay a certain benefit to them in the future. As such, we're not necessarily the employee deferring compensation as they would with a 401k contribution. They're not actually reducing their taxable liability. This is a fringe benefit that's funded with the employer's dollars. But because it's funded with employer dollars, it also is subject to the IRS and the 409A plan provisions that really put this plan in under a slightly more scrutiny than loan regime split dollars, because we are creating that promise to pay. We are creating that contractual pay, and thus it brings in certain other aspects to the plan design, such as we're starting to account for a liability now for that future promise to pay. There's additional reporting and compliance and administration that goes along with deferred compensation that aren't as cumbersome in loan regime split dollar and exec bonus. But really, from an employer perspective, deferred compensation is probably one of the most attractive to the employer to really not only reward, retain, but really handcuff, because in these arrangements, the employer is really dictating the terms of a vesting schedule, who participates, even an eligibility criteria. So it could be our key executives that have been here a year. So they really have a way to come in and formally design a compensation package that puts the employer at the forefront of all decision making and at all of the control from that perspective. And again, these types of arrangements typically we see more often, not in white collar professionals such as CPA firms, attorney firms, larger entities, because of some of the complexities and administrative needs of this type of plan design. So how do you fund? So if we've just talked about separating the contractual agreement with the funding solution, how do you fund a deferred compensation liability? Well, as an employer, you could take on that risk and self-fund if you go. What I mean by that is leave the plan unfunded, which means essentially you're going to assume that the business will have enough business revenues in the future to pay out those promised benefits. But by taking this approach, really you do not create any offset to that liability today. So we know that if I'm promising my key executive a $10,000 a year benefit at retirement, that's creating the liability today. But if we're not set aside any funding today, we're not offsetting that liability, and that can have a negative impact to some of our financial statements. The business could instead say, hey, we don't want to have that risk that we're going to have to manage our business revenues and potentially put ourselves in a situation where it could be a big business disruption to pay out a liability. We're going to go ahead and start a savings account, if you will, using equities or mutual funds. And this obviously is a better direction because we are setting aside funds. We're creating a savings account to offset that benefit liability, but the utilization of equities and mutual funds is not as tax efficient. So during the accumulation phase, the business is going to be taxed on investment earnings, but also on the back end, when we have to pay out promised benefits, there's the liquidation and additional capital gains exposures. And with these particular funding solutions, when we talk about formally or informally funding these assets have to be to maintain the tax favorability that 409A allows for deferred compensation. You do have to keep these assets subject to the employer's general creditors. So it's got to be something that as an employer, you're making that known to your employees that their benefits are creating a liability for the business, and thus them potentially becoming a creditor in the future if the business has some solvency issues. But the last option, which is really the one that we're focused in on, is utilizing life insurance as the informal funding vehicle to offset that deferred compensation liability. And why is life insurance an attractive solution? Well, one, our tax value, the cash accumulation inside the policies are going tax deferred. And we certainly know life insurance from a distribution capacity really provides tax advantaged loans and withdrawals. And even more so, we have leverage. So our savings account with mutual funds, $1 is matched to $1. With life insurance, our dollar is now creating death benefit leverage so that if we do have to pay out survivor benefits or looking to help the business recover costs after benefit payments are made, the death benefit proceeds certainly go a long ways to helping the business recover plan costs and or meet any other survivor benefit needs that are outlined in that contractual arrangement. So just a quick run through. Again, what we're talking about here is a SERP informally funded with life insurance. How does it work? Well, first and foremost, we have to start with the SERP agreement. That's where the business and the key executive enter into that contractual arrangement. As such, the business is trying to offset that liability. They will take out a life insurance contract on that key executive. They'll be the owner and the beneficiary, the business being the owner and the beneficiary. The premiums are non-deductible. So that's important consideration, as we mentioned, when we're determining whether this is a viable plan to not design, is that deduction important? But with a deferred compensation, informally funded with life insurance, that premium is non-deductible. We fund this over time. We've accumulated a significant accumulation inside the life insurance contract. Now the employee meets a retirement event, and the business now has to make good on their promised liability. At this point in time, we've got to promise to pay our key executive a certain benefit. That point in time, we're paying that key executive compensation, and at that point, the business is able to realize the tax deduction. So the tax deduction comes in the future on the back end when those retirement benefits are paid out. The key executive, of course, pays taxes on the compensation received, and if there's any survivor benefits built into the contractual arrangement where the key executive passes away before receiving their full entitlement, then the survivors could receive benefits there. So as we look kind of across the spectrum of solutions, we have executive bonus, which really favors the employee. We have split dollar, loan regime split dollar, that really kind of balances the employee concerns with the employer needs to retain and reward and really help to protect their interest. And then on the further end of that spectrum from an employer perspective is deferred compensation. And I think each one of these strategies has its place and is really on a case-by-case basis. But I think it does go back to a thorough discovery process that we've talked about in the previous sessions of helping your business insurance team really identify who are we looking to reward, is the tax deduction important, and what is the tax structure of the business. And from there, we can really help you all devise the appropriate insurance solution and funding strategy to address executive benefit needs. At this point, I'll turn it back over to Alan for any conversations, but really just wanted to appreciate everyone's time over the last several sessions to tie in, what business insurance planning involves, the three pillars of risk management, and how we can at Lincoln help partner with you to make business insurance planning easier to navigate.
That's fantastic. Michael, another great job. I did have a question here. You may have already answered it. Is there a solution to mitigate the tax owed by the employee in a Section 162 plan?
Great question. So there is actually a way to help the employee pay that obligation. One is in product design. And so in those situations where we're trying to help that employee minimize the out-of-pocket tax expense, you could use a higher early cash value product in your product design that's going to help inflate those high early cash values, giving them a pool of funds that they could withdraw to help pay the taxes on that compensation bonus.
Excellent. Well, I don't see any more questions here. I'd like to thank everybody for taking the time to spend with us today on this. Again, these seminar sessions will be on our website for you to view again. And if you have any more questions, you can reach out to one of your life sales managers or myself, and we will get those questions answered for you. Again, thanks, Michael, for your expertise on this. It was very helpful, I think, to a lot of people.
Great, and we appreciate the partnership and look forward to working with everybody on cases moving forward.
All right, thank you guys. Have a great afternoon.
Thank you.